So let's start doing the adjustments, working notes first. So as usual, all the figures are in thousand, in dollar, thousands. Working note number 1, we have to prepare convertible loan note. It's nothing but a repetition. Convertible loan note. So when did they issue convertible loan note? 1st April X5. When is your year end? 31st March X6. So in the beginning of the year, a convertible loan note was issued. So what you have to do is that on 1st April X5 itself, you have to show the split. 1st April X5. How much is equity and how much is initial liability? So we have to calculate equity. How will you calculate equity? Equity equal to, as you're aware, we have already done this question as well and many questions during our accounting standard class. Equity equal to cash proceeds minus initial liability. So now we have to calculate initial liability. How will you calculate initial liability? We have already done this question in our single entity same type as well as many questions during our accounting standard class. So initial liability is nothing but present value of interest plus present value of principal repayment. So we have to calculate present value here. Cash flows, discount factor, and present value. Bold, and I have centered it. So here, how many years? 3 years. 1, 2, 3. Cash flows, and one more 3. Cash flows, as you're aware, the first 3 years, it will be interest. How much is the interest? 40,000. That is numbers, 4 lakhs, sorry, 400,000. That is numbers multiplied by 100. And how much is your interest rate? 6%. Check whether it is end a year. Yes, it is end a year. But we are calculating it in thousands. So it will be equal to 400,000 multiplied by $100 multiplied by 6% is interest whole divided by, we are converting into thousands. So it is 2,400. 2,400 converted in thousands. Second year also 2,400. Third year also same 2,400. And at the end of third year, you will be also repaying 400,000. So again, 400,000 numbers of loan note into 100, you will get total value of loan note. Our answers, all the figures are in thousands, so divided by 1,000, 40,000. Now, discount factor is, which will be the discount factor? There are 2 factors given, 6 and 8. Which should you take? You should take the interest rate for non-convertible option. So an equivalent loan without conversion right would have an required interest rate of 8%. So you have to take 8%. So discount factor at 8%. So discount factor is given 0.93, 0.86, 0.79 and 0.79. Present value equal to 2,400 multiplied by 0.93. You can, what you can do is that you can copy this and, okay, this is 0. You can, sorry, there's a small mistake. This is 0.86, this is 0.79 and this is 0.79. So all this, what you can do is that you can paste it. Okay, or you can simply multiply each and everything as well. So this will be sum of these three figures. So it is 37,792 as initial liability. Done. So now we can find out what is the value of equity. Equity will be cash proceeds. So equity equal to equity, showing it here, equal to cash proceeds. How much is cash proceeds? 400 and 40,000 in thousands minus initial lease liability. How much is your initial lease liability? E16, 37,792. So this is 40,000 minus 37,792, 2208 equity. So just write here, show in SOFP, show in SOFP. Done. Show in SOFP. So now what you have to do is that you have to calculate non-current liability. You have to show the convertible loan note as at or as on 1st April, sorry, as on year enders 31st March, right? As on 31st March, convertible, and is missing, convertible loan note as at 31st March 20x6. So how do you calculate that? That is initial liability, then add effective interest rate less interest paid, actual interest paid. So your initial liability equal to, sorry, E16. So initial liability equal to E16. Give reference. Effective interest rate will be this 37,792 multiplied by discount factor rate, that is 8%. So this is equal to this multiplied by 8%. Always make sure in your examination for your multiple choice question, just check whether all the items that you show in profit and loss account, make sure it is time proportioned. If this has been issued during the mid of the year, then interest, sorry, you'll have to multiply with 6 by 12 or 3 by 12, that time proportion. Actual interest paid should be based on nominal value, that is 40,000. It is 400,000 into 100 divided by 1,000 into actual interest rate paid. So this is equal to minus 40,000 multiplied by 6%. So you will get the most important one, convertible loan note as at, no need to type, you just copy this and come to here and paste this. Convertible loan note as at 31st March 20x6 is 38,415. Then if you do like this, you will get half mark for calculating equity. You will get half mark for calculating interest, effective interest, and you will get another half mark for calculating convertible loan note as at 31st March 20x6. Now, as usual, what you have to do is that you have to show where you will show all those things. So show here, this one effective interest rate is shown in SOPL as finance cost. So examiner will know that you know effective interest is finance cost and it should be shown in SOPL. And 3841 show in SOFP. You can also make sure as a non-current liability or simply write as show in SOFP. We'll get marks. Clear? Okay. So first adjustment is over. We are going to do the next adjustment. Non-current asset. Directors desire to revalue leased property at 66.3 million on 1st October X5. Here comes a twist. When is your beginning? 1st April X5. When are you revaluing? On 1st October 20 X5. Triage. Company does not make annual transfer from the revaluation surplus to retained earnings to reflect the revaluation gain. However, the revaluation will give rise to a deferred tax liability at the company's tax rate of 20%. Leased property is depreciated on a straight line basis and plant and equipment at 15 per annum using reducing balance method. No depreciation has been charged on any non-current asset for the year ended 31st March 20X5. So let's first focus on revaluation. Which asset they have revalued? They have desired to revalue leased property on 1st October 20X5. So second working note will be with respect to revaluation. Working note number 2, revaluation of leased property. So revaluation of leased property. When have they revalued? On 1st October 20X5, fair value is given. Fair value is given. How much is the fair value? 66.3 million. That is 66,300. 66,300. Now, to know the revaluation gain or loss, what you have to do? You have to compare fair value with carrying amount at the same date. So now you have to calculate what is the carrying value of leased property at 1st October 20X5. So another working carrying amount at first, or you can show there itself. If you are good in Excel and if you don't mess up, you can show there itself. I'm showing separately carrying amount at 1st October X5. So what have they given with respect to leased property? They have given cost. How much is the cost? 75,000. Cost is 75,000. Now, what have they given? They have given information regarding accumulated depreciation at the beginning. Accumulated depreciation on 1st April 20X5. Lease property is 15. So 1st April 20X5 accumulated depreciation. So what you have to do? You have to subtract accumulated depreciation of 15,000. So when you subtract, you'll be getting carrying amount. But now don't go there and compare. Why? Because this carrying amount is as at 1st April X5. We need to know what is the carrying amount of 1st October 20X5. So what you should do? You have to depreciate from 1st April to 1st April to 1st October depreciation. April, May, June, July, August, September. Don't take October because it's 1st October. So depreciation. You have to further reduce depreciation. So what should you do? Now you have to read the question. What is the useful life? Leased property is depreciated on a straight line basis and plant and equipment 15%. So they have given plant and equipment as 15%. Don't take that one because that is depreciation of plant and equipment. What we need depreciation of leased property. The question very clearly states that original life is 25 years. So original life is 25 years. So you can calculate depreciation like this. Depreciation. So original. So let me ask you a question. Is it 60,000 divided by 25 years multiplied by 6 by 12? Or is it 75,000 divided by 25 into 6 by 12? So should you divide by 60,000 or 75,000? 75,000. Why? Straight line method. Straight line method. Straight line method, you have to calculate depreciation on cost. 60,000 is carrying amount. I'm very happy none of the students have committed any mistake. Everyone have stated it as 75,000. I'm very happy. So 75,000 divided by 25. No need to take 20. Now this has not been depreciated. A student has stated that I have to divide by 20. Why? Because that student might have calculated remaining useful life. What you have to remember is that we are not finding depreciation after the year end. We are finding depreciation before revaluation. So before revaluation, you have to calculate it on the normal rate. After revaluation, you have to base it on remaining useful life. So 75,000 divided by 20 into 6 by 12. So this is equal to, again, further depreciation minus 75,000 divided by 25 into 6 by 12. So now I can do a sum. Close the brackets plus enter. What I'll get is it, yes, 1,500. No, you cannot take 60,000 divided by 20. Your answer will be correct because it's 1,500. Because when you take 60,000 divided by 20 into 6 by 12, even if your answers is correct, examiner will, okay, yes, in that case you can do. Because you are calculating based on remaining useful life, yes, you can take it. You will get the marks. So if you're taking 20, make sure you're doing it 60,000. So what we have found? We have found carrying amount as on 1st October 20x5. Clear? So carrying amount as on 1st October 20x5 is 58,500. Sorry, I'll wait for a few seconds, 1 minute, so that all the students can write this down. Then I will go and calculate the revaluation surplus as well. Okay, done. Yes, Sohail, you can do that. You can do that. So carrying amount equal to 58,500. It's not working. So if it doesn't work, E45 equal to E45. So now carrying amount is 58,500 and fair value is 66,300. So definitely it is a revaluation surplus as on 1st October X5, as well as it will be same in the year end also. So revaluation surplus. So right here, show in SOFP, but remember, this is not the figure you will be showing in SOFP. Revaluation surplus you will be showing after deferred tax, because the question very clearly states that revaluation gain will give rise to a deferred tax. So I'm just going to write here revaluation surplus to be shown in SOFP. Right now I'm writing, because if you don't write like this, definitely you are going to forget to take that 20% deferred tax and you will lose your half mark. So revaluation surplus to be shown in SOFP is This is revaluation surplus, then less deferred tax. So I'm showing here itself. This is equal to, showing SOFP E36. This is equal to E36 minus deferred tax. Deferred tax will be E36 multiplied by 20%. So this is 7,800 minus 7,800 into 20%. In other words, you'll be showing 80%. 6,240. So I'm highlighting this here, and I'm also writing here SOFP. So all the columns in F suggest where you have to show this. Done. Just giving some time so that all the students can write this. Okay. Now what we have to do? They've stated that they have not calculated depreciation as well. They have not calculated depreciation as well. Idrisa Savane, why we deduct revaluation surplus. I hope you have not attended Accounting Standard 12 income tax class. We have already done that. Deferred tax you have to reduce from a revaluation surplus. We have already learned it during our IAS 12 income tax. If you have not attended, I will suggest you please to attend the revision class. We'll be practicing those income tax questions once again. So next, what's next? With respect to this itself, they stated that they have not calculated depreciation. So I'm just going to show here itself, working note number 3. Working note number 3. Everyone please listen. Working note number 3. Depreciation of leased property. I'm just simply saying depreciation. Okay. So first we are going to calculate depreciation of leased property. Depreciation of leased property. Okay. You have already calculated depreciation. When is your year end? 31st March. So when does the year begin? 1st April 20x5 till 1st October 20x5. Sorry, you have already calculated the depreciation. How much is that? You have already calculated depreciation equal to 1500 E43. So equal to E43. Everyone please listen. I'm just typing E43. Now it's showing in 1500 negative. I need it to be positive. So what I do? Minus. Now, remember, your year end is not 1st October. So from 1st October 20x5 to 31st March, also you have to calculate this 31st March depreciation. So now it has been revalued upward. We have learned this class. Our class was started in April 27 or 20, I don't remember. With regarding financial reporting, I think it was April 20, almost 3.5 months before. And the first chapter we have learned was Accounting Standard 16. In Accounting Standard 16, we have learned that once an asset is revalued, you have to calculate new depreciation. Depreciation should be calculated. Depreciation should be calculated for revalued asset like this. Revalued depreciation equal to revalued amount minus new residual value. If there is no residual value, new value, take the old value divided by remaining useful life. So what is your revalued amount? Revalued amount is 66,300 minus new residual value not given. Then if new is not given, you take the old value. Old is also not given. Divided by remaining useful life. Can anyone tell me what is the remaining useful life? remaining useful life. It's not given. Remaining useful life. We're just going to give you 1 minute to think. Please think from this point of view. Please think from this point of view. You will be able to identify it. 1 minute. Now it is 12:16. I will start discussing at, okay, it's now 12:17. I will start discussing this at 12, sorry, not 12, 2:18. So 1 minute. Please think. Okay, done. So let's discuss this. Remaining useful life. Now, what you have to remember, an asset's leased property is 75,000. Yes, most of you are right. Lease properties accumulated depreciation is 15,000. So now listen, remaining useful life. I'm calculating remaining useful life. Cost is dollar. This is for your purpose. You need not to show the examiner. Cost is $75,000. Useful life is 25. So cost is 75,000. The information given. Useful life is 25 years. Useful life is 25. So depreciation per annum, depreciation per year equal to 75,000 divided by 25, 3,000 per year. Accumulated depreciation at or as on 1st April 20x5 is how much? 15,000. So your per year depreciation is 30,000, 3,000. So, and 15,000 so far it has been 15,000. So this is my question. How many years have been used? That is, asset was used for how many years? Equal to 15,000 divided by 3,000. Asset was used for 5 years. This asset was used for 5 years. However, at 5 years, total accumulated depreciation is 15,000 divided by 3,000 per year. So, in other words, remaining useful life as at 1st April 20x5 is how much? 25 minus 5 equal to, we have done a similar question during our accounting standard 16 question as well. So this is, just give me a minute. Yes, equal to 25 minus 5, 20 years. 20 years. But remember, this remaining useful life is as at 1st April x5. We don't need it. When did we revalue? We revalue it on 1st October 20x5. So after further 6 more months. So in other words, remaining useful life, if at 1st April is 20 years, remaining useful life on 1st October 20x5 will be 20, this 20 minus further 6 months minus 20 years minus 6 months That is, it will be equal to 19.5. Okay, now here you have to be very careful. 19.50 years. Clear? Any doubts? I hope no doubts. So now what we have to do? So this is 66,300 divided by 19.5. It's for a full year into you need only from a period from 1st October to March 6 by 12. So this is equal to fair value 66,300 revalued amount divided by 19.5 years. So you will get dollar per year. It is dollar 66,300 divided by 19.5 years. Dollar in the numerator and years in the denominator. So the answer you will get 66,300 divided by 19.5 years. It is 3,400 per year, dollar per year. We don't have full year. You have only 6 months into 6 by 12,700. Clear? So total depreciation will be 3,200. So here only you have this problem. Most of the other students don't have this problem. 3,200. So total depreciation. Total depreciation SOFP. SOPL. Show in SOPL. Done. Now there is one more depreciation. What is the depreciation? Depreciation on plant and equipment. Depreciation of plant and equipment. So I'm going to write this working note number 3, depreciation of leased property. Working note number 4. Sorry. Working note number 4, depreciation of plant and equipment. So depreciation of plant and equipment. How will you start with depreciation of plant and equipment? So they have given plant and equipment cost. How much is the cost here? 72,100. So 72,100. Now on 1st April 20x5 accumulated depreciation. Accumulated depreciation of plant and equipment is 2,800. So minus 2,800. Then you will get carrying amount, but as at 1st April 20x5. Now what have they stated? They have stated leased properties depreciate on a straight line basis and plant and equipment at 15% per annum using reducing balance method. So now we have to charge depreciation 31st, 31 March. At the end, you will charge depreciation. Reducing balance method, sorry. So reducing balance method, depreciation will be calculated on the carrying amount, which is 44,000 into 15%. It is therefore entire year. It's not 6 by 12. Don't confuse. That is plant and equipment. It is for an entire full year. Because plant and equipment, you have not done anything with respect to plant and equipment. So plant and equipment, depreciation is for a full year. Okay, don't do 6 by 12. Yes, it's full year. Okay, so now adjustment number 2 is also over. What is adjustment number 3? Then there is adjustment number 4. That's all. In September 20x5, directors of Triage Company discovered a fraud. In total, $700,000, which had been included as receivable in the above trial balance, has stolen by an employee in September 20x5. So during the year itself, there was a fraud detected by the management. Working note number 5, I presume. Yes, working note number 5. So working note number 5, something about fraud. So what was the fraud? In total, 700,000, which had been included receivable above trial balance, had been stolen by an employee. Okay, so there is no such receivable actually. Actually, receivables have paid this amount, but they have stolen. Which accounting standard is this? Accounting standard 8. Changes in accounting policy, changes in accounting estimate, and prior period item. It was a very small topic, and this question, to my best of knowledge, we have covered during that accounting standard 8 class as well. So tell me, what should you do with receivable? What should you do with receivable? There is only a few options. One, every FR question, there is only 3 options. One, you add trade receivables. 2, you less trade receivables. You deduct trade receivables. Third, ignore. What should you do? Please answer. Trade receivables have actually paid the amount, but accountant has misappropriated. Yes. So this trade receivable is not there. So what you have to do, you have to cancel this trade receivable. Will they pay you again? No, because it has been already been paid. They are not going to pay you again. So how do you correct this error? You credit trade receivables. So credit trade receivables or less trade receivables. So credit trade receivable means what you have to do, you have to subtract it. Credit trade receivables by how much? 700. That is deduct trade receivables in SOFP. Okay, in SOFP. Now, no need to write the journal entry unless you ask, but you show the treatment, deduct trade receivables in SOFP. Now, 450,000 is related to year ended 31st March X5. When is our year end? Our year end is 31st March X6. So a few of this thing around 450,000, that is 450 is with respect to previous year. What should you do? Should you show it in profit and loss account? Yes or no? Or should you show it somewhere else? If you are saying somewhere else, please tell me where. Any ideas? No one? You already covered this. It was a very small standard. I think we covered within one day. Yes. No, it's not bad debt. Retained earnings. Those students who are saying bad debt or provision, please, it will be better in your interest to attend the revision class. Accounting Standard 8. Let me open my notes regarding Accounting Standard 8. This is a note which I have shared you. See, almost same type of question we have practiced. This was actually June 2008 adapted question. Read this. In late March 2008, directors of D discovered a material fraud perpetrated by company's credit controller. Investigations revealed that a total of 4 million of trade receivables shown in SOFP had in fact been paid and money had been stolen by the credit controller. An analysis revealed that 1.5 million had been stolen in the year to 31st March X7. What is our year end? March 2008. So in previous year, 1.5 million has been stolen. It's the same question. It's the same question. And we have also done one more question like this. In March 2012, Internal Audit Department discovered a fraud committed by the company's credit controller. Outcome of fraud is that 4 million of company's trade receivable have been stolen by the credit controller and are not recoverable. Of this, 1 million relate to year ended 31st March 11. When is our year end? March 2012. And this 1 million relate to previous year. We have already done two type of such questions, which has been asked in June 2008 and June 2012. And same question has been repeated as a part of your section C in September 2016. So this is what I normally tell my students. Nothing is new in financial reporting, except maybe a 5-mark question. Not only in financial reporting, whether it be audit and assurance, I can only tell you the subjects which I take. There is nothing new in financial accounting F3. There is nothing new in financial reporting FR. There is nothing new in audit and assurance double A, that is F8. There is nothing new in strategic business reporting, except for there are a few items known as current issues for which they will introduce a technical article. And there is nothing new with respect to audit and advanced audit and assurance, and there is nothing new with respect to advanced performance management. All those are same as previous years. Only thing, maybe 5-mark question, they will introduce something new. Apart from that, everything remains same. So if you practice question papers, you are going to pass. And my notes. So when I told you the best way to pass financial reporting, I will tell you how you have to study from tomorrow onwards. Anyway, I'm telling you one more time. If you're not attending the revision class, okay, you can start studying from Tuesday itself. If you are attending the revision class, after the revision class, what you have to do is that every day practice one question from consolidation. I've already told you, I'm again repeating, one question from consolidation every day, one question from single entity every day, and one question from ratio analysis every day, and a few accounting standards. If that is not possible, then one ratio analysis every day. Every day you have to practice ratio analysis, and one single entity or consolidation on alternative days, and a few accounting standards every day. If you do like this, what is the advantage? Every day you're practicing ratio analysis, and by the time you go for your examination is on 10th, you have 1 month, and if you're writing September 17th, you have 37 days. There are only 27 question papers, to my best of knowledge, 27 or 28. That means you might have done all the ratio analysis question. One day each means all the ratio analysis question. If you practice like that, automatically after a few days, you will start see the interlinkage and common points. And once you reach your 25th day or 26th day, you will know comfortably that what you should do in ratio analysis question. And if you're practicing consolidation and single entity alternative days, it means you might have already done 12 or 13 single entity question and 12 or 13 consolidation question as well. So you're very much ready, and you have already practiced accounting standards every day. And what's the advantage when you're practicing single entity? Those accounting standards will be again repetition. So it will be again a revision for you. And if you're confused with respect to ratio analysis, I suggest you attend my revision class. It is for 6 hours to 8 hours. It will be ratio analysis. I'll teach you ratio analysis in a different way, and I told you how. Okay, so debit, what you have to do, as most of the students are, if anything, now remember this, if it is previous year fraud, debit retained earnings, and if it is current year fraud, debit SOPL. So how much is previous year? It's 450. So the balance will be current year. Okay, so this one, deduct from retained earnings, deduct from retained earnings, because it is debit. Deduct from retained earnings in SOFP, and this one show in SOPL. Clear? No, Mansoor, I'm not aware of that. It's new for me also. I'm listening it for the. Yes, David L. It's a prior period error. It's a prior period error. So this is done. Now the last working. What's the working note number 6? So if you have forgotten, I will advise that today itself you go and practice accounting standard 8 question. It will hardly take you less than 10 minutes because accounting standard 8 is a very small topic and only 2 questions were there regarding same type of question and a few questions regarding change in accounting estimate policy, a few theory question. It will hardly take 10 to 15 minutes. So I advise you, those who have mistaken, please go and learn it today itself so that you don't forget it. Working note number 6. What's working note number 6? A provision of 2.7 million is required for current income tax on profit of the year to 31st March X6. The balance on current tax in trial balance is under or over provision of tax for the previous year. In addition to temporary difference relating to information in note 2, 31st March X6 carrying amount of is net asset are 12 million more than their net tax base. Okay, now this is tax charge. So let's read tax charge. Tax charge. Tax charge in SOPL. So what's the format? This is the second or third time this is coming. Current year, current tax provision. Add under provision of current tax of previous year. Under provision of current tax in previous year less over provision of current tax in previous year, then current year deferred tax provision. How will you find current year deferred tax provision? Temporary, or we can say taxable difference multiplied by tax rate, then same things, add under provision of deferred tax. So I am copying it, less over provision of deferred tax, and I'm pasting it. So only thing I have to do is that this under provision of current tax, I have to change it to under provision of deferred tax and over provision of deferred tax. So let's start doing this one by one. So what have they given? They have stated that a provision of 2.7 million is required for current income tax. So current year provision is 2,700. Balance on current tax in trial balance is the under or over provision. So balance in current tax, there are two things, deferred tax as well as current tax. So deferred tax is credit. So credit means it is an over provision. So over provision of deferred tax equal to it's minus 3,200. And current tax it is 700. It is debit. Debit means under provision. Next. Just give me a minute. Okay. Now what is there? The balance in addition to temporary difference relating to information note 2. What was note 2? Note 2 they were talking about a revaluation surplus. Deferred tax on revaluation surplus will never be shown in tax charge in SOPL. We have done a few questions which the question says that it is included. So we have excluded that. Now they are saying that it is included. It's not included that. In addition to that, there is temporary taxable difference. So current year deferred tax provision, taxable difference in addition to revaluation surpluses, 12,000 multiplied by how much is the tax rate? Tax rate. How they given tax rate? Here, company's tax rate they have given here in adjustment number 1 itself, tax rate of 20, sorry, in adjustment number 2, tax rate is 20%. So multiplied by 20%. We have done n number of lots of questions regarding provision income tax questions. So please go and revise it. 12,000 into 20%. So that's it. You will get current year tax charge 2,600, tax charge in SOPL 2,600. This we have to show in SOPL. Done. Okay, now we have to prepare an adjusted SOPL, etc. So I'm just going to wait for 1 minute so everyone can finish this. It's 2:43. I'm just giving time for every student to finish it. So it start at 2:44. So then, so now let's prepare the first part. Preparing a adjustment required to draft SOPL. Can you scroll up? Yes. This one is a calculation, 700. Okay, then just give me a minute. Now we are going to prepare the adjusted profit and loss account. Okay. Answer A. Starting with the answer, what have they asked us to prepare? They've asked us to prepare a schedule of adjustment required to draft. So just say schedule of adjustments. It's same like yesterday's question. You calculate, you adjust it. So dollar, thousands, bold, and centered. So let's start. What have they given? Draft PBIT. Draft PBIT before considering all those items. So we start with draft PBIT in the trial balance. Draft PBIT as per the trial balance before considering all those items is 30,000. Now what you have to do? You have to go there and pick out all the SOPL items. So now listen. I'm just going to show you the usefulness of this item scratchpad. So I'm using a scratchpad here. I'm adjusting this. You can adjust the size if you want. Okay. So now what are the item you have to show in P&L? One, effective interest rate. So instead of going up there and scrolling every time, I'm using the scratch pad, effective interest rate. In my question, it is E22. So E22. Next SOPL. When is next SOPL? Show in SOPL. Depreciation of what? Depreciation of leased property. So next one, depreciation. This is our own purpose. Depreciation of leased property. Which cell? E56. Next, let's go down. Next, depreciation of plant and equipment is 73. So depreciation of leased property, then depreciation of plant. This is for your purpose. So you can write like this, E73. So we have all the information on the left hand side in the scrap paper. So we can avoid going up and down. Then fraud. Fraud is E78. Fraud, E78. Anything else? Last one, tax charge, that is E96. Tax charge, E96. Now what you can do is that you just have simply spent 1 minute for doing this. Now everything is a piece of cake. Less, what less? Effective interest rate, or you can say finance cost. Finance cost, convertible loan note. Even no need to write convertible loan note, simply writing for your purpose. This is equal to minus E22. Done. Now depreciation on leased property, and depreciation on plant. No need to write plant and equipment. You can save your time. Depreciation on plant. Depreciation of leased property equal to E56. You have written in your scrap paper. And plant equal to minus E73. Yes, you can directly copy from Scratchpad and paste in the Excel or Word of ACC answer. Yes, it's possible. But what can you paste this? Effective interest rate E22, depreciation E56. That is not possible. But you can copy from the Scratchpad and paste it in the answer sheet. What you have to remember is that whatever you write in the Scratchpad, examiner will not even look at the Scratchpad. So don't write any examination in Scratchpad. Examiner will not look into it. Whatever you're writing, it should be there in the Excel sheet or in the Word document. You can copy from the Scratchpad and paste it in the Word document or Excel sheet. Depreciation on plant. Next one is fraud. Fraud related to current year equal to E78. So minus E78. Next, tax charge. Tax charge E96. Again minus. That equal to minus E96. Okay. So just quickly go through your SOPL. Equal to sum. Those who are slow, don't worry. I'll be sharing this note with you. Yesterday's class, I have already shared the note, and today I will again share the notes. So now the adjusted profit is 14,327. Clear? I'll wait for 1 minute. Then we'll do SOFP and take a break. After the break, I'll quickly go through the consolidation, that one question, the treatment regarding contingent consideration. I'll tell you the treatment. It will take only 5 minutes. And then I will send you the question. You can practice yourself, and I will send the answer as well. And after that, discussing on contingent consideration, if time permits, definitely time will permit, we'll do one more singularity question. See, OCA, they have not asked. They have asked the question, prepare a schedule of adjustment required to draft PBIT to give profit or loss. They are only asking to give profit or loss. Yes, definitely, Sohail, I will give you that. That is why I have blocked all my dates for Tuesday and Wednesday to complete all those pending items. No, Idrisa, we are not going to do that. Adjusted profit. So next one, answer B. Statement of SOFP of financial position as at 31st March 20x6. So dollar thousands, first one, you have to write assets. What are the assets you have? You have only two assets, PP, leased property and plant and equipment. So we'll start with non-current assets. I'm going to start with assets. That format doesn't matter. I'm writing assets, then non-current assets. If you're not writing this, also no issues. If you don't have time, start with the first thing itself, leased property, then plant and equipment. What else do you need? That's it. Then it is trade receivables and other current assets. That's it. So I'm writing current assets. Current assets, just check whether there is any inventory. No inventory, equity, retained earnings, PBIT, convertible non-note, lease property, plan, trade receivables, other current assets. So trade receivables, other current assets. So lease property, we have to go up. Again, I'm going to show you the usefulness of scratch pad. So we have to go again up there and again go through this. So you can have a scratch pad for all of this. So what I'm going to do is that I'm going to type one more here, SOFP items. So all the SOFP item I'm going to write here. So just 1 minute for writing all those things and 1 or 2 minutes for typing in the SOFP. So SOFP. So where is SOFP? First, equity 2028. So we say option, right? Convertible loan note option. So you have everything one place. It's D6. Then what else in SOFP? Yes, convertible loan note as at 31st March. Loan note. This is for your own purpose. So I'm writing C loan note, etc. Roughly E27. Yes, Sohail, you can write like that. You will get full marks. You will write good full marks. So next one, revaluation surplus. I'm just going to write revaluation surplus E36. Next SOFP. Revaluation surplus to be shown is not E36, it is E47. Next. What is next? Retained earnings minus E77. Trade receivable. You can simply write receivable minus E79. Okay. Now there are two more items. One is yes. Where is that? Okay, fine. So that's it. Now what we are going to do is that Depreciation is E73, right? Okay, E73. Lease property. Lease property you can directly take. Why? It has been revalued. So revalued you have to show in fair value 66,300. Plant and equipment we have not calculated there. So what I'm going to do is that plant and equipment it is 72,100. You can also show calculations there if you want. It is 72,100 minus accumulated depreciation of 2,800 minus current year depreciation of 6,600. So this is equal to 72,100, or you can show the calculation there itself, minus E73 or something. Let me check E73. Depreciation on plant. E73, yes, correct. Okay, next one. Lease property, everything we have taken. Now, lease property, the 66,300 is on 1st April, this one is 1st October. From this, you have to subtract the depreciation for 6 months. How much is the depreciation for 6 months? 1,700. So it is E54 minus E54. So that is 66,300 was on 1st April, sorry, 1st October, then minus 1,700, 6 months depreciation. Because we are finding out on 31st March 20x6. Next, trade receivables. You have already written something there in the scratch pad. Trade receivable is 79. So how much is your trade receivable balance right now? Trade receivable balance is 28,000. So out of this 28,000, 700,000 is not receivable. So minus 700. So in your calculation, this is equal to 28,000 minus trade receivable is 79. Other current assets equal to 9,300. I hope there are no further assets. If there, we will go and check. 1,38,600. So total assets is 1,38,600. Now we start with equities and liability. Equities and liabilities. So equities and liabilities, start with equity first. Equity, how much is your equity shares? 50,000. Then retained earnings. Now see, retained earnings is on 1st April 20x5. So retained earnings is as on 1st April 20x5. So how much? 3,500 plus whatever profit you have, adjusted profit 14,327 plus current year profit adjusted 14,327. Check whether there is any dividend paid. No dividend paid. So that's it. So retained earnings equal to 3,500 plus, I think it is EE 112, 17,287. Yes. Now, there is one more adjustment regarding this. What is that? We have given here retained earnings is 77. So that fraud equal to minus E77, 17,377 is the answer. That fraud of 450 previous year. Okay. So now what is there? Convertible loan note. Okay. See, I have given a space here. So I will have enough space to write a few items. What are the few items? After equity, there is retained earnings. Sorry, retained earnings. Now, convertible loan note. Convertible loan note, what you have to remember is that convertible loan note, there is an equity element involved. In convertible loan note, there is an equity element involved. We say that it is as option or other components of equity. You can write whatever you want. So I'm just writing other components of equity. Other than this, there is any other component of equity, that is convertible loan note. Or we can say option. There's an option given to them. So option, as you know that it is in D67, sorry, D6. So I have to type D6. It's there. Now what I have to do? Convertible loan note over. Lease property, plant and equipment. In case of lease property, there was a revaluation surplus as well. So a revaluation surplus. Revaluation surplus I have given E47. See the advantage? Now we don't have to go up. Now what is next? After revaluation surplus, current liabilities. Okay. Come here. Before current liabilities, there is something known as known current liabilities. Those students who have attended Accounting Standard 12 class, IS 12 will be able to understand. The second thing I'm going to say. One is convertible loan note. That is, have you written? Yes, E27. See, I don't have to go up. Now, before this, one more item is there. Before you start with current liability, there is one more item that is known as deferred tax. Deferred tax is always a known current liability. What will you show in deferred tax? The total taxable difference, including revaluation surplus, multiplied by tax rate. We have already covered such questions in income tax class. So what is the total taxable difference? 1. Read the adjustment number 4. In addition to the temporary difference relating to information in note 2. What is information in note 2? Information in note 2 says that there is a revaluation surplus. How much is your revaluation surplus? I'm going to show you two ways you can do this. How much is your revaluation surplus? Go up. Revaluation surplus E47. Revaluation surplus 6240. So definitely there is a difference. 6240. That is a revaluation difference. 6240 plus. What's the next difference? Next difference is that net assets are 12,000 more. So 12,000. So the total difference is 6,240 into 12,000 into 20%. That is equal to, I'm just showing here, equal to 6,240. That is revaluation surplus. E47 equal to, sorry, equal to E47 plus 12,000 multiplied by 20%. You will get 3,648. There is one more method of calculating this. I'll show you that. Okay, there is somewhere some differences there. Some mistake. Just give me a minute. 6,240 is not the revaluation surplus. Sorry. 6,240 is not the revaluation surplus. The real revaluation surplus is, that is 6,240 was revaluation surplus to be shown in SOFP. The real revaluation surplus is 7,800. 7,800 E36. So this is real revaluation surplus is E36. E36. If we correct this, E36. Okay. Now, there is one more method how you can find this particular item. How is that? Two ways. One, now remember, what is the deferred tax related to revaluation surplus? Take your calculators. What is the deferred tax related to revaluation surplus? Deferred tax related to revaluation surplus, 7,800 into 20%, 1,560, plus in your tax charge, we have given a revaluation surplus. Where is it? In your tax charge, current year deferred tax provision of 2,400. So 1,560, that is revaluation surplus deferred tax, plus 2,400, 3,960. So the same answer we have got here also, 3,960. Is this clear? We have already done this type of so many type of questions during accounting standard 12. So deferred tax, asset or liability, we have to show it in non-current liability. Okay. So now what is there? After deferred tax, interest payment 2,400. What is that interest payment? Note number 1. Triage. That 4,000 into 100, 40,000, 400,000 into 100 into 6. That's not the amount we have to show. There is no payable, nothing. That's we have already calculated. Effective interest rate of convertible loan note have already been considered in draft payment. Now current tax. Now there is one more item, tax payable. So there is lot of application of tax in this question. So if you have forgotten how to calculate deferred tax, if you have forgotten how to take tax charge, if you have forgotten how to take tax charge with revaluation, without revaluation, if you have forgotten what amount should be shown in tax payable, in deferred tax, etc., if you have those doubts, quickly go and practice accounting standard 12 plus. Today itself we have done enough, lots of question papers on that. So we have done enough questions on that. A lockdown, it's not 6,240. That's also the same mistake I have committed. 6,240 is not deferred tax on revaluation. 6,240 is revaluation surplus of 7,800 minus 1,560, that is 7,800 into 20%. That 6,240 is a revaluation surplus that you have to show in revaluation surplus, you have to show in SOFP. So you have also committed the same mistake. See, this 6,240 is a revaluation surplus to be shown in SOFP. What we need to know that what is the deferred tax related to this revaluation surplus? Your revaluation surplus is 7,800. So 7,800 into 20%, 1,560 is the amount that you have to show. So if you're taking 6,240, it is after revaluation, sorry, deferred tax. So what's the correct revaluation surplus? You have to take 7,800, that is a revaluation surplus, plus 12,000, you will get 19,800. Total difference is 19,800 into 20%, 3,960. Clear? So please don't commit that mistake. So those who still have confused, please go to your accounting standard 12 notes. This is why I told you yesterday itself to practice those questions. Now, what's the tax payable? Can anyone tell me what is the tax payable? What is the amount of tax payable? Please type your answer. Tax payable. I'll show you the working as well. Working. This is the working of tax. What is the tax payable? Whatever is your current year current tax provision, that will be tax payable. So tax payable is 2,700, that is E83. Please go through your accounting standard 12 notes. E83, I presume, equal to E83. Now, I'm just leave one or two line. If our balance sheet doesn't tally, we'll go there and check what we have forgotten, whether we have taken everything properly. No. Okay. Now, what is missing? What is missing? There is one item that we have missed. Only one item. As you are aware, in the trial balance, there is one more item known as, see, there is not only current tax and deferred tax, etc., etc. There is one more item. They have shown current liabilities separately. Where is it? It's here. Current liabilities 17,700. In your examination, my dear students, if your balance sheet doesn't tally, don't panic. And don't even bother to check where you have gone wrong. In your examination, you won't be able to understand where you have gone wrong. So skip it and go to the next question, because tallying balance sheet doesn't carry any marks. Tallying your balance sheet mark is absolutely zero. Absolutely zero. If you have taken everything into the balance sheet, you will get half mark each. So unlike your plus 2 or PUC or your O levels, A levels, graduation, etc., your balance sheet won't tally. Without tallying your balance sheet, you can pass. You need only 50 marks to pass. So you need to get only 50% correct. You can make 50% mistakes, still you will pass. Total equity and liability 138,600. 138,600 balance sheet tallied. SOFP tallied. Done? Okay, fine. So now it is 3:13. Take a 5 minutes break. We'll round it off. Take a 7 minutes break. We'll start at 3:20. At 3:20, I'll be taking a particular consolidation question, contingent consideration. And I will explain, we will read that question and I will tell you what is the treatment you have to show for contingent consideration. Then I'll give that question. I will upload that question in Google Classroom. You have to do it as a homework. I will also upload the answer, because all the points, all the adjustments are repeated except for that contingent consideration. And at 3:30 or 3:35, we will start with one more single entity question. Okay, so we have now done 3 single entity question. If God bless, we'll do one more single entity question today, 4, and 2 more single entity question tomorrow, 1 or 2 more question, making it 6 single entity question. And tomorrow we'll wind up our class. Okay, so take a 6 minutes break. We'll start at 3:20 with consolidation, contingent consideration. Okay, so let's start. So Merlin Joseph, last line of adjustment number 3, that remaining useful life, you might have already calculated in the depreciation. Yes, you have to show deferred tax asset or liability in SOFP. That has already been shown. Deferred tax liability has been shown here as a non-current liability. Okay, so now quickly read this question number 6. This is actually the question that I normally practice in the face-to-face class in Kappan School of Accountancy and Management. I'll be sharing this question with you. This is the previous year question paper as well. So from this, we are going to learn the main adjustment, how you have to treat contingent consideration. Now, before that, you have to know what is contingent consideration. And I will ask you, I have shared you two technical articles related to consolidation. Those who have already read those technical articles are there in ACCA website. You can go there or scroll down in my Google Classroom. I have shared the link that you have to practice. Those who have read it, there was one mention about contingent consideration treatment of, in that technical article they have explained in detail what are the types of consolidation that will be asked, consolidation question and consolidation adjustment that will be tested, and for each and every adjustment they have given you a example, one or two example, and a one big question was also there. So please go through that technical articles if you have not gone through that. In that technical article, there was something mentioned about contingent consideration. Now read this question. On 1st April 2009, on 1st April 2009, Pican acquired 75% of Sanders equity shares in a share exchange of 3 shares in P for every 2 shares in S. The market price of P and S share at the date of acquisition were 3.2 and 4.5. Nothing new. In addition to this, P agreed to pay a further amount on 1st April 2010. When you have acquired on 1st April 2009. After 1 year from the date of acquisition, you have agreed to pay a further amount on 1st April 2010 that was contingent upon post-acquisition performance of Santer at the date of acquisition. So my first question, please type your answer. Even if you're wrong, I don't mind. This type of acquisition, this type of consideration, we call it a particular name. What is this name? What is the name we normally call to this? What is the name we normally use? Agreed to pay a further amount on 1st April 2010. Yes, we normally say this as deferred consideration. We normally say this as deferred consideration. Yes, you're right. Next, continuing with this. At the date of acquisition, P assesses the fair value of this contingent consideration at 4.2 million. So at the date of acquisition, P assesses the fair value of this contingent consideration at 4.2 million. So my first question, at the date of acquisition, the value is 4.2 million. P has assessed. So is this present value or fair value? Read that sentence again. At the date of acquisition, parent has assessed the value of this consideration as 4.2 million. Is it present value or future value? What do you think? It's present value. Very good. So this is my first question. Where will you show that present value? Where will you show that present value? You'll show that present value in purchase consideration at the date of acquisition. Present value of that consideration at the date of acquisition. Clear? Nothing new actually. Continuing with this. But by March 31st, 2010, it was clear that actual amount to be paid would only be 2.7 million. So normally we say that deferred consideration, each year the value increases, right? The value actually increases. If your present value is 5 right now, your future value will be more than present value. It will be 6. Why? Due to the time value of money, change in time value of money. Why time value of money is changed? Due to inflation. Every economy there will be inflation. Inflation is not bad. We have the notion that inflation is actually bad. Inflation is not actually bad. Every economy will have inflation. It's not possible not to have inflation. Only thing, inflation should not be too high. If it is too high, you will have the issue that you have in Zimbabwe. Just search Zimbabwe. A one loaf of bread cost 1 million in Zimbabwe. The value came down. Or situation in Venezuela, that inflation will be there. That's not good. But every country will have inflation of 1 or 2%, which is okay. Now, present value is given. So normally your present value and your future value will be more than present value. Now, what are they saying? But on 31st March 2010, this is as per 1st April 2010, it is 4.2 million. So actually on 31st March 2010, it should be more than 4.2 million because 4.2 million is present value. But it was clear that actual amount to be paid will be only 2.4 million and you have been asked to ignore discounting. So this is contingent consideration. Why this is known as contingent consideration? Because read the question. In addition, this part, the second paragraph, first sentence. In addition to this, that is share exchange, parent agreed to pay further amount on 1st April 2010, that is after 1 year from acquisition, that was contingent upon the performance of Santer. That is contingent upon the performance of Santer. If Santer performs well, they've already acquired 75%. Now they're saying that if you perform well, we will give you some more money. But you have estimated that you will have to pay 4.2 million after 1 year. So this is contingent consideration. This is deferred as well as contingent. That means deferred consideration means you have to definitely pay. Deferred consideration, you promise after 1 year we'll pay you this much money. That is deferred consideration. Deferred consideration means you're not paying right now. Deferred consideration means at the date of acquisition you're not paying. You're deferring the payment. You're paying it at a later date. That is deferred consideration. This is not exactly deferred consideration. This is somewhat like deferred consideration, but not exactly like this. This you are saying after 1 year from date of acquisition, we will pay you some money. But how much is that money will depend upon your performance. The other thing is that we'll say that we will pay you this much of money after 1 year. That is deferred consideration. This is contingent consideration, depending upon the performance. So you estimated at the date of acquisition, the present value of this consideration is 4.2 million. So take it in goodwill calculation. But when you reach 1 year after, the performance was not that satisfactory. You don't have to pay 4.2 million. How much you have to pay? 2.7 million. Now use your common sense and please tell me the answer. What is the treatment of deferred consideration? There are 3 treatment of deferred consideration. This is how we will be doing our revision class. Instead of practicing more question, we'll be focusing on each and every adjustment. Like purchase consideration. I told you there are 5 types of purchase consideration. 1, you pay cash consideration. Then we will take one problem regarding that purchase consideration and teach you how you have to show that cash consideration. Then deferred consideration. Then I will teach you only how you have to show purchase consideration related to deferred consideration, etc. So we'll be taking ratio analysis also same thing. How will you do ROC? Then we will go to a few questions of ROC plus minus, etc., etc. 2 or 3 questions. So like that, then your interpretation problem will be over. So after the revision class, I can guarantee you that every day when you practice interpretation of financial statement, first few days you will have certain issues, but after that you will know how to write it. Guarantee. As well as consolidation as well. You won't make that small mistake that you have been committing. Share exchange, you were committing mistake. You were taking wrong figures, multiplying with subsidiary shares, etc. Those mistakes will not be committed if you attend the revision class. I will correct this. Okay. So continuing with this, what is the treatment of deferred consideration? I'm talking about deferred consideration. It has got 3 treatments. 3 three treatments. Treatment number one, you take the present value. You take the present value and show it in working note number 3. Purchase consideration at the date of acquisition for the purpose of calculation goodwill. Second one, since there is a present value involved, in this question it is not there, but since there is a present value involved in deferred consideration, what will you do? There is unwinding of discount. You have to show it in SOPL, finance cost. And third one, we have to show the amount deferred consideration payable in SOFP. Which amount will you show? It is always present value plus unwinding of discount. If it is 1 year, there is no issues. You can directly show that amount. Otherwise, to be a safer side, to be on safer side, you can take present value plus unwinding of discount. That is a treatment of deferred consideration. Now let's look into this contingent consideration. It will also have 3 treatment, my dear students. Treatment number 1 we have already discussed. The present value of that contingent consideration. In this question, it is directly given 4.2 million. Take it to working note number 3 as usual, like deferred consideration. Purchase at the date of acquisition. Along with share exchange, add this 4.2 million. Along with share exchange, there is also share exchange. Forget about unwinding of discount. They say that it's not there. Third one, that is my question. How much amount will you show as payable in the SOFP that you prepare 31st March 2010? Use your common sense, you can tell. Use your common sense. How much? Please type the answer. Yes, very clear. 2.7 million. Because the question has clearly stated that on 31st March 2010, you were expecting only 2.7 million. So you showed 2.7 million. Nothing new. Nothing new. Now listen. Now listen. So on 1st April, I'm writing here itself, okay? On 1st April 2009, you're shown something as payable, 4.2 million. Now on 31st March 2010, you're going to show the same payable, contingent consideration payable, all those nonsense, 2.7 million. So what has happened? From 1st April 2009, you were expecting 4.2. Now it is 2.5. So the payable balance have reduced. So this is my first question. If payable balance reduce, what will be the journal entry? One time they have asked the journal entries. What will be the journal entry? Will you debit payable or credit payable? That's all my question. The difference is 1.5 million. So from 4.2, you have to reduce the payable to 2.7 million. If you have to reduce payable, will you debit payable or credit payable? Yes, very good. Debit payable. Debit payable 1.5 million. Now what will you credit? You will credit SOPL. You will credit SOPL 1.5 million. What is this credit SOPL? It's an income. It's a form of income. You were expecting 4.2 million to be paid. You have shown 4.2 million to be paid. You don't have to pay 4.2 million. You have to pay only 2.7 million. So it show it as like an income, finance income, or show it as separate income. Clear? That's all with respect to contingent consideration. So I'm just going to read it again, the next paragraph. On 1st October 2009, we acquired 40% of equity share of Adler, that is associate, by paying $4 in cash per acquired share and issuing at par $107% loan note for every 50 acquired share. Same as our purchase consideration, you have acquired an associate by paying cash as well as issuing loan note. Okay, what I'm going to do is that now I'm going to read the adjustments. Let's see whether all those 5 adjustments are similar. Read the first adjustment. At the date of acquisition, fair value of S property, plant and equipment was equal to carrying amount with exception of subsidiaries factory which had a fair value of 2 million above carrying amount. Revaluation surplus of subsidiary, working note number 2, nothing new. S has not adjusted carrying amount of factory as a result of fair value. This requires additional annual depreciation. So in the post-acquisition period, minus additional depreciation in reporting date, nothing new. I'm skipping this part, then we will discuss this later. Read the third one. Read the second adjustment. At 31st March 10, P's current account with standard was 3.4 million. This did not agree with equivalent balance in Sanders' book due to some goods in transit invoiced at 1.8 million that was sent by parent on 28 March 2010 but had not been recorded by Sanders. P sold all those goods at cost plus 50%. So what is this? Intercompany receivable and payable. Difference due to goods in transit. So what you have to remember? One, we have done same type of question. One, they have given debit balance 3.4 million. That is receivable is given. Payable is not given. The difference is due to goods in transit. You have to either plus or minus and find out the value of payable and subtract. Now, where will you show goods in transit? You will show goods in transit in inventory as well. When you show it in inventory as well, this is intercompany inventory. You'll have to remove unrealized profit. We have exactly done same kind of question. We have exactly done same kind of adjustment. And this is a repeated adjustment again in the examination. Next, 3. Pays policies to value non-controlling interest at fair value at the date of acquisition. For this purpose, subsidiaries company share price at that date can be given. Normal thing. Fourth one, impairment tests were carried out on 31st March 10, which concluded that value of investment was not in associate was not impaired. But due to poor trading performance, consolidated goodwill was impaired by 3.8 million. So listen, this is the first time we are seeing an impairment of goodwill in consolidated SOFE. But if you have practiced the 9 questions that we have already done, you will be able to sail through smoothly. How was the treatment? 1. Working note number 3. Goodwill, less impairment. That's it, less impairment of 3.8 million. Then, 2 more places it will go. Were non-controlling interest at reporting date. How will you show non-controlling interest at reporting date? Fair value of NCA date of acquisition plus NCA share of post-acquisition profit of subsidiary company minus NCA share of impairment. In 1 or 2 question, I was repeatedly stating that format. So if you have learned that format, you will be able to do this. And one more area. So NCA share, NCA took it. Now whose share is there? Parent share. Parent have to bear the loss, their share. Where will you show the loss of parent? In working note number 5, retained earnings. Okay, and that's it. Assume all profit accrue evenly throughout the year. So that means if there is any mid acquisition, you can take 6/12 or 3/12. Now read the first adjustment once again, but the second paragraph. Let's see whether you are able to do this. If you're able to do this, you can really congratulate yourself because you have understood consolidation perfectly. Whatever questions they ask in consolidation, section C, you will be able to answer. See, what's the word I have used? Whatever question they ask in section C, you will be able to do. I told you they will ask questions regarding this consolidation in section A and section B. My dear students, this is not new. I'm going to tell you this. I can confirm that there will be 1 or 2 questions in your section A or section B related to consolidation. So practice those consolidation questions, objective type questions. Take your BPP revision kit or Kappan kit and start practicing consolidation question. I told you how they will ask. They will ask purchase consideration. They will ask what is the share exchange. They will ask what is the NCA at reporting date. But please practice. Why I'm saying please practice? Because the way they present the question will be slightly different. So please practice. If you practice, you may commit mistakes. But when you read the answer, you will be able to identify where you made a mistake. Now, what you have to understand is that section A, section B, your skill is different. Section C, your skill is different. So please practice consolidation, objective type, and multiple choice question from Kaplan or BPP. That is a must. What I say, that is a must. Spend at least 1 day for that. You should spend, because I have seen my students at Kappan School of Accountancy and Management at face-to-face class struggle doing consolidation. not section C. They will be very good at doing section C question, but section A and section B, they struggle a lot. Because the way they present the question, it will be a bit confusing. So what you can do, you do by yourself. You will make mistake, but once you practice, you have already gained the concept. You will be easily able to do it, but you will commit mistake. Don't worry, you will commit a few mistakes, but make sure you practice it. Otherwise, you will be in trouble. 2 or 4 marks, you will wrongly take and commit a mistake. Don't let anything to chance. Okay. Next, read the next one. Also at this part, the second paragraph, also at the date of acquisition, subsidiary had an intangible asset of 500 for software in SOFT. P directors believe software to have no recoverable value at the date of acquisition, and Sanders wrote it off shortly after acquisition. Okay, what are they saying? At the date of acquisition, subsidiary had an intangible asset of 500,000 for software in SOFP. Okay, they're talking something about subsidiaries asset. So this is my first question. Subsidiaries asset, etc. Subsidiaries questions, etc. Where will you show subsidiaries asset? In which working note? That's the first question. Which working note will you show subsidiaries asset? Working note number 2. Very good. So working note number 2, it will be like this. You already know, at reporting date, at date of acquisition, and post acquisition. Right? Okay. So now what are they saying? At the date of acquisition, subsidiary had an intangible asset of 500,000 for a software. P's director believed software had no recoverable value at the date of acquisition. Okay, full stop. If you are seeing such a question, what will you do? So I'm writing intangible asset here. Intangible asset software. What will you do? Yes, that's it. Madhumida is right. No, it's not amortization. Yes, fair value of intangible asset at the date of acquisition. Sachu Thomas has identified. So this is my question. Fair value of intangible asset date of acquisition. Yes, very good, Sachu Thomas. Now this is my question. Fair value of intangible asset at the date of acquisition. What should be the value I'll be writing at date of acquisition? Please tell me that value. Read those things again. It's not 500. It's not 500. Madhumita, you are right. It's 500, but it's not plus 500. It's minus 500. Why minus 500? Read. At the date of acquisition, S had an intangible asset of 500. Directors believed this software have no value at acquisition. That means now there is a 500. Directors believe this doesn't have any value. So what you have to do? You have to write it off. 500 minus. Sir, brand name, etc. Brand name, etc. Directors stated that in SOFP of subsidiary it is not valued, but when we acquire, we are assigning it a value. So brand name, you're bringing brand name into books. So that is why we added intangible asset in one of the question we have practiced. Here, there is an existing intangible asset, but directors of parent are saying that that doesn't have any value. So what you have to do, you have to remove it. It is revaluation downward. So instead of plus, it's a minus 500. Clear? And one more thing. Sanders wrote it off shortly after acquisition. So this is my question. What will be the value? You have to show it in books at reporting date. What's the value? They have written off it. What's the value? Yes, very good. 0. So what will be post acquisition? 0 minus 500. You will get something 500 here. It will be like that. If you go through the BPP textbook, they will have a detailed explanation on it. No need to do that. Reporting date minus date of acquisition, whatever you write post acquisition. I'm repeating that once again. In this particular question, they have stated an existing intangible asset doesn't have any value. The questions that we have practiced is that directors are saying that even though that brand name is there or customer relationship is there, that are the two questions we have practiced. Brand name as well as customer relationship, it was not there. But while acquisition, parent has valued it. So while acquisition, they're creating something. So it is like revaluation surplus. We will write that as a positive figure at the date of acquisition. When the question, if the question is silent, we will write the same figure at reporting date as well. Do that two questions that has brand and customer relationship. We have already done it. You can go through that and see that. Now, this question is a bit different. This question is saying that subsidiary is having an intangible asset, but parent is saying it doesn't have any value. So at the date of acquisition, we have to cancel. So minus that, revaluation downwards. Now, one more thing. If they didn't, now see this. Now, let me ask you a question. If they didn't use this word, in this question, they say that after it was written off. So at reporting it is 0. So there was one question paper which they have asked. This particular part was not there. The question was that also at the date of acquisition, subsidiary had an intangible asset of 500, but directors believe that it does not have any recoverable value at the date of acquisition. So minus 500. If the question stopped there, what amount will you write in at reporting date? Please tell. What will you write? Yes, same. Very good, Madhumida. And Debagdami, no, minus 500. Why? This question we have written at 0 because it very clearly stated that it was written off shortly after acquisition. If they say was written off shortly after acquisition, means at reporting date it is 0. If they have not written that, you write the same thing like your revaluation surplus at reporting date. Remember this adjustment and deferred consideration and contingent consideration. So I'll be sharing you this question today, as well as I'll also be sharing the answer mostly by tomorrow or day after tomorrow. So consolidation by day after tomorrow. This is your 10th question, I seems. 9th question answer is not there. I'll be sending that answer on Tuesday, as well as this answer on Tuesday or maybe tomorrow. Okay, it will be sent to you. And by Wednesday, I'll be updating that acquisition related topic as well. And I'll be sending that note as well. So by Tuesday, by Wednesday, you will have all those notes provided if Babu is not scheduling revision class on those days. Otherwise, within 2 days after the revision class is over, I'll be sending you all the updated notes. So you'll have comfortably 20 or something days to study properly. Clear? Yes, definitely I'll be adding this also. It's also there. Contingent consideration is also there. Okay. Now, we are going to practice another question with regard to single entity. If you don't finish, don't worry. We'll continue it in tomorrow's class, or I will give you as a homework. Maximum, I will try to cover at least the adjustment. So we have done 3 questions. One is MJ 2018. The other one is MJ 2019. And we have finished September 2016 as well. Let's focus on September, December 2018. September, December 2018. We have done this question, ratio analysis. Okay, very big question. So just give me a minute. Since it is a very big question, let me check if there is any small questions that has been mentioned in the examiner's report. Can't. Because since it is a very big question, will require a bit of time. So there is one more question which examiner has stated to practice. It is being given in specimen exam. Yes, we'll do this particular question. It's a very good question and a pretty small question as well. So we'll do one thing. Since we had a long discussion on consolidation, we'll again take a 5 minutes break. We'll take a 7 minutes break. It's now 3:53. We'll start at 4. Have a nice cup of coffee or tea or drink a glass of water. Maybe wash your face, etc. We'll start at 4. We'll take a 7 minutes break. Okay, then we will do this question as well. Or before that, let me take a poll, then we'll start. If you say that you don't need a break, we'll continue. So please, I'll just take a poll that whether you need a 5 minutes break. So this will be for 30 seconds and I will share the results as well. So 20 more seconds, please vote. Ten more seconds. Okay, so I'm ending the poll and sharing you the result. 67% has stated that they need a 5 minutes break. Okay, we'll take a break. We'll start at 4 o'clock. It's now 3:54. We'll start at 4 o'clock. Take a 5 minutes break. Okay, so let's start. Let's quickly start with this working. What are they asking on the right hand side? Prepare a schedule of adjustments. Required to retain earnings of candle company as at 30 September 20x5 as a result of information in notes 1 to 3. So 1, 2, there is only 3 notes. Then prepare statement of SOFP and prepare extracts of Candy statement of cash flows for operating and investing activity for the year ended 30 September X5, which relate to property, plant and equipment. If you have gone through all these past question papers, which has been uploaded in ACCA website, there is no questions regarding cash flow statement in section C. So it's being a bit reduced importance right now. I'm not saying that they have removed it from the syllabus. Cash flow statement is still part of the syllabus, but for a long time they have not asked cash flow statement. So that is why we have not taken. And if you, but I advise you must be ready with cash flow statement. Please practice a few cash flow statement from BPP or Kaplan. So if at all they ask, you are ready. And you can go to opentuition.com. There is something site known as opentuition.com. Most of you will be aware. If you're not aware, it's a website where they provide you classes for all the subjects free of cost, along with materials to study, not BPP or Kaplan, their materials to study, that too free of cost. And I find it very useful for a certain subjects if you are already a professional or if you already have enough work experience. So you can go to that website opentuition.com, and there will be 40 minutes or 80 minutes of class regarding open cash flow statement. So you can go through that website and learn that one or two questions. Just be ready, 80 minutes or something, just be ready. And those students who are from Kerala, those who are students from Kerala, or those who are in Middle East who know the vernacular language of Kerala, Malayalam, we have a lot of students from Middle East and a few of them are Keralites as well. I have already uploaded one or two questions regarding cash flow statements in my YouTube channel. Unfortunately, it is in Malayalam. It's not meant for ACCA students, but the concepts remain the same. It is primarily meant for students who are doing CMA, Certified Management Accounting, or Cost and Management Accounting in India. And I was a tutor at CMA chapter in Trichur, as well as Profin CA campus in Trichur, as well as BC Academy in Trichur. Trichur is a town in Kerala. So due to the lockdown, we were not able to continue. So what I did was that whatever portions was pending, I uploaded those classes in. I took the class. I did a few questions. It was recorded. I recorded it and I sent it and uploaded it in my YouTube channel. So those who are from Kerala, you can follow that one. For those who are from outside India or in India outside Kerala, if I get time, I will upload one or two questions. If I get time, I will upload one or two questions in YouTube channel and will let you know as well. Okay, but I'm not guaranteeing. I hope I will get some time. Okay, so if I upload it, I will inform you in the Google Classroom that it has been uploaded, and I will share the link as well, so you can go there and see it, or you can subscribe and press the bell icon for the notification. I know I have told you I'll be uploading 2 ratio analysis question that I have promised you, and that promise I will keep. Once, just give me a few days after the revision class. Within 1 or 2 days after the revision class, again I'll be taking a break, not committing classes or any other work. And if anything is pending during the revision class or this 2 days, I'll be uploading that 2 ratio analysis question that I have promised I'll be uploading. Okay, so that's my promise that I will do. But cash flow statement, if I have to get time, I will upload it. But we will discuss this cash flow statement right now itself or tomorrow itself. Okay, so you have a general idea of cash flow statement, and I'll spend around half an hour tomorrow for explaining what is cash flow statement, etc., etc. So now let's read this. After preparing draft statement of P&L for the year ended 30 September 20x5 and adding the current year's draft profit before any adjustment required, note 1 to 3, to retained earnings, summarized trial balance is given. So what is retained earnings? Have they given? So retained earnings as at 30 September x5. This is 15,500. What they say? After preparing draft statement of P&L. So P&L is already prepared and adding current year's draft profit. So already SOPL is prepared and they have also added current year's draft profit before tax or whatever to the retained earnings. So this 15,500 includes current year profit as well. But what is missing? Before any adjustment required, but they have not considered any adjustment that has been stated in adjustment number 1, 2, and 3. It's almost same. So continuing, the trial balances equity shares of $1 each. Retained earnings, it's 30 September x5, and this is closing retained earnings including profit. Proceeds of loan, 6% loan note, note 1. Investment property at fair value, note 2. Land 5 million and building at cost, note 2, 35,000. So total it is 35,000. So land is 5 million and building will be 30 million. Plant and equipment at cost, accumulated depreciation at 1st October x4, building, plant and equipment, those accumulated depreciation beginning is given 1st October x4. Your year ending is 30 September x5. So beginning accumulated depreciation is given. Current assets, current liabilities, deferred tax, interest paid, current tax, and something known as suspense account as well. So read each adjustment. The loan note was issued on 1st October x4. When is your year end? 30 September x5. At the beginning, a loan note was issued and incurred issue cost of 1 million, which was charged to profit and loss account. So my first question is this: loan note was issued. So is it an asset or liability? That is my first question. Is it an asset or liability? Even if any student who have not attended financial instrument and you have attended the last 2 classes regarding single entity, we have already covered out of 4 items in financial instrument, we have already covered 3 items in financial instrument. Item number 1, treatment of convertible loan note, showing it as equity, non-current liability, etc. Second one, there was an asset which included brokerage. How you have to show? It's one type of question in financial instrument. Second thing, how will you show a liability? So now my first question is that what will you do with that 1 million? Can you charge to profit and loss account? No, you cannot charge to profit and loss account. So how will we start? So I'm just going to start here. Working note number 1. Working note number 1. Loan note. As usual, all figures are in dollar thousands. Working note number 1, loan note. So loan note will start like this: cash proceeds received. So what is the cash proceeds received? Cash proceeds received is 1 million thousand minus issue cost. Sorry, loan note was issued on 1st October x4. So loan note, how much is loan note? Proceeds of 6% loan note, 30,000. 30,000 minus, where will you show issue cost? Here. So 3,000 minus, sorry, 30,000 minus 1,000, 29,000. Interest of 1.8 million, that is 30 million into 6% was paid on 30 September x5. That is 1.8 million. So interest paid is being shown. That's wrong. We have to show effective interest. And it is being, loan is redeemable on 30 September 9 at a substantial premium, which gives an interest rate of 9%. No other repayment are due. So what will we do? The normal thing, add. What we have to add effective interest rate. sorry, add effective interest rate. How much is the effective interest rate? This 29,000 multiplied by 9%. You have to check whether it is for full year. Yes, it is for full year because it was issued during the beginning of the year. Less interest paid. Interest paid will be based on nominal value of 30,000 multiplied by the real interest rate of 6%. Since it is paid during the beginning of the year, you can take 6%. If it is issued during the mid of the year, you will have to multiply by 6 by 12. Time proportionate. So interest, depreciation, etc. You have to time proportionate. 1,800. So sum loan note. This is loan note as at 30th September 20x5. You show this in SOFP. Show in SOFP as a known current liability. Okay, done. So what are the adjustments required? Now I'm writing here, few adjustments are required. Adjustment number one, what is adjustment number one? They have made a mistake here. They've reduced 1,000. They have charged 1 million to profit and loss account. It is wrong. So what should you do? Tell me what you have to do. How will you correct this? Should you add 1,000 or subtract 1,000? Yes, add 1,000. Add back 1,000. It's not reduce. You have to add back. What have they done? What have they done? They have shown charges to P&L. If you are charging it to P&L, your expense increase. If your expense increase, your profit reduce. Now it's a wrong treatment. Your profit has wrongly reduced. So you have to correct it. You have to remove it from the expense. But they are not asking you to prepare SOPL. If they were asking you to prepare SOPL, you can reduce it because they have shown it in SOPL. You have to reduce it. But here our question is not SOPL. Prepare a schedule of adjustment required to retain earnings. Your profit is now being reduced. So to correct it, you have to add back the profit. You have to be very careful whether they're asking SOPL. If they're asking SOPL, more expense has been there. You reduce the SOPL. But here it is not SOPL, it is profit. So you have to add back. So I'm writing here the adjustment that is required. Add $1,000. Add $1,000 to profit or retain earnings. Why adding back? Same answer. They have charged it to profit and loss account. It's a wrong treatment. When they charge to profit and loss account, expense is now more. If expense is now more, what will happen to your profit? Your profit will reduce. Now you have to correct it. What correction is required? The question is retained earnings, profit correction. What will you do? You will add it back. You will add it back because they are not asking you, sir, last question we did minus. Last question, it was profit and loss account. One question they have asked you to prepare corrected profit and loss account. If they're asking you to prepare corrected profit and loss account, this particular question, this particular cost will be shown in administration expense or finance cost, any cost. It should not be shown. So you have to remove it from the expense. So minus, when it is SOPL minus, But the question is not to show SOPL. The question is that to adjust retained earnings. Retained earnings is profit. Now, what have you done? This cost has wrongly been treated as an expense. If it has been wrongly treated as expense, you have calculated your profit less. More expense means less profit. Wrong, less profit. So you have to correct it. So what you have to do? You have to add it back. Add 1,000 to profit. Next. So that's it. Now, what you have to remember is that what they have stated that before any adjustment required, note 1 to 3. So whatever there is in your note 1 to 3, they have not taken anything. Okay. So next one, number 2. What's number 2? On 1st October 20x4, read the question. So, okay, I'm getting a question, Benita Jacob. When do we add this issue cost to loan rather than deduct? When it is an asset. When it is an asset. When you're purchasing loan note. We have done a question yesterday or day before yesterday that loan note you have purchased. It is your asset. This you have issued. This is your liability. Go through my questions. We have done enough number of questions during financial instrument class. Go through those notes. Okay. Now, known current asset. On 1st October 20x4, Candy Company owned 2 investment property. First property had a carrying amount of, what is on 1st October x4? Beginning of the year. Your year end is 30 September x5. So in the beginning of the year, Candy owned 2 investment property. The first property had a carrying amount of 15 million and was sold on 1st December x4. That is during this year itself for 17 million. So what is the profit? 2 million. Disposal proceeds have been credited to a suspense account in trial balance above. So is there a suspense account? Yes. What is the disposal proceeds? You received 17 million. So debit cash 17 million has been shown. How do I know it is debit cash? Because the question clearly states that the disposal proceeds have been credited to a suspense account. So the disposal proceeds is debit cash that has been created to a suspense account. On 31st December X4, the second property became owner-occupied property. So it was transferred to land and building at fair value of 6 million. Wow. So what happened? The second was an investment property. It became an owner-occupied property. It's the opposite. We have done many questions in Accounting Standard 40, investment property, where it was an owner-occupied property. There was a change in use and it became an investment property. Here it is opposite. But at that time itself, I have taught you the method or how you have to calculate, and I have written in the whiteboard. On 31st December X4, second property became an owner-occupied property and was so transferred to land and building at its fair value of 6 million. Its remaining useful life on 31st December X4 was considered to be 20 years. Ignore any deferred tax implication. And the next one. Price of property has increased significantly in recent years. So the directors decided to revalue the land and building. The directors accepted a report of an independent surveyor who on 1st October X4 valued the land at 8 million and building at 39 million on that date. This revaluation specifically excludes transferred investment property described above. So you don't have to bother about that transferred investment property. Remaining life of this building at 1st October X4 was 15 years. Candy does not make an annual transfer to retain profit. However, revaluation will give rise to a deferred tax liability. With respect to this property, you have to consider deferred tax liability. Income tax rate applicable to Candy is 20%. Third one, plant and equipment is depreciated at 12.5 per annum using reducing balance method. No depreciation has yet been charged on any non-current asset for the year ended 30 September 20x5. Loads of adjustment. We'll take one by one. We'll discuss this one by one. So I'm just going to give you 1 more minute. Please read this 3 paragraph by yourself. It is 4:20 right now. I'll give you 1 minute. Please read it by yourself. You need to read by yourself and identify the figures. Just 1 minute. So done. Okay. Let's now do one by one. Working note number 2. Investment property that has been sold. Working note number 2. Investment property sold or disposal of investment property. One by one. So, investment property sold, what we have to do? 1. They stated that on 1st October X4, Candy owned 2 investment property. The first property had a carrying amount of 15 million and was sold on 1st December X4 for 17 million. Disposal proceeds as that's all. So now what you do on 1st October 20x4, what's the carrying amount? Carrying amount is 15 million, that is 15,000. On 1st December 20x4, they have sold it. Sold. Sale proceeds. How much is the sale proceeds? 17,000. So what's the profit? Profit is 17,000 minus 15,000. 2,000 is profit on disposal. 2,000 is profit on disposal. That's it. You got half mark. Profit on disposal. How you got this? 17,000 minus 15,000. Profit on disposal. What should you do? Very simple. Show in SOPL. Show in SOPL. But now listen. Don't write show in SOPL. You can write show in SOPL, no issues. But the question is not to prepare SOPL. What's the question? Prepare a schedule of adjustment required to retain earnings. They have already recalculated retain earnings. So this is my question. What will you do with this profit on disposal? Will you add it to retain earnings, or will you subtract or deduct retain earnings? So what should you do? Add retain earnings or reduce retain earnings? Yes, very correct. Add return earnings. So what you have to write here? You just write add to retain earnings. Add to retain earnings. Now there is one more treatment with respect to this. I'll come to that later when we prepare SOFP. Okay. So now there is another investment property. This is property number one. This is investment property sold. This is property number one. Then there is another property, property 2. We are preparing another working note. Working note number 3, investment property 2. Okay. Investment property 2. Read that. On 31st December X4. So is it during this year? Yes. October X4 is our year to 30 September X4. During 31st December X4 in this year itself, what happened? Don't confuse. December is not your financial year end. September is your financial year end. Your financial year begins on October X4 and ends on 30 September X5. So on 31st December X4, second property became an owner occupied property. Full stop. So there is a change in use. So tell me, whenever there is a change in use, what you have to do? What you have to do? So I'm just going to take one note and discuss investment property 40 for 5 minutes. Let's revise it. Let's revise it. Investment property. What we have learned investment property. There are only a few points that we have learned in investment property. What is investment property? Any property that is held for the purpose of earning rental income or for capital appreciation. That is known as investment property. So if few students are complaining the audio is messed up, please check. Okay, sound is breaking. It's proper now. It was okay now. Okay, fine. So is my sound now okay? Okay, fine. Okay, is my sound audible? Is it now audible? Yes or no? Yes. Okay. Okay, so let's continue. So what is investment property? Investment property is a property held for the purpose of earning rental or capital appreciation. That's the first point. What will be included in property? Land and building. So any land and building you're holding for the purpose of earning rent or capital appreciation should be treated as investment property. Machinery, car, vehicles, etc. for the purpose of rent or shares or bonds or any other financial instrument held for the purpose of capital appreciation will not be covered in investment property, because machinery, car for rent, machinery and cars are not property. Any other asset like shares, bonds, etc. held for capital appreciation will also not be covered under IAS 40 investment property. Why? Because shares are not property. That's it. Then the second thing, what you have to remember is that investment property can be shown, it has to be shown at initially recognized at cost. Then second one is that subsequent recognition in SOFP, you can either follow cost model. If you are following cost model, it will be valued at cost minus depreciation. You can also follow fair value model. If you're following fair value model, you have to show it in fair value. But there is no depreciation. So don't subtract. And if you're following fair value, any increase or decrease in fair value, opening value, closing value, increase. Opening value, closing value, decrease. Any increase or decrease in fair value when compared with opening and closing, that should go to SOPL. There is no revaluation surplus or revaluation deficit with respect to investment property. Next one. What have we learned? Now, there will be certain situations where there is change in use. Let's take first case. It was first a property, plant and equipment. We have done similar questions. Owner occupied property. Owner occupied property. Now you had an owner occupied property. You were occupying this property. Now you are vacating the property and converting this as an investment property. Converting this as an investment property. You are renting it. So what's the journal entry you have to pass? The journal entry is debit investment property and credit accounting standard 16 PPE. So I'm just bringing an amount into this. Carrying amount is 500,000. Carrying amount of PP is 500,000. But what we have learned? What we have learned is that when the new asset, what is the new asset? This investment property is a new asset, should be shown at its fair value at the date of change. So you have to go there and check what is the fair value of this particular building. Let's say it was 700. This building doesn't change. It is still yours. The building, you are using it for your administrative purpose. Such building that an owner uses for his or her business is known as owner occupied property. Now you have vacated the premises and you have given it as rent. So now it becomes rental property. So whenever there is change in use, this is what we have learned. Whenever there is change in use, the new asset should be recorded at the fair value. That's the first point. So you're getting this as revision as well. We'll cover this during revision as well. But if you are not paying for the revision class, you're getting this for free of cost. The revision of entire accounting standard 40. You have to show a fair value. So what's the fair value? 700,000. And the old asset should be shown at its carrying amount. What is the carrying amount? 500,000. Definitely there's a difference. What will you do with this difference? This difference, you have to check what was the nature of this asset before this change. The nature of the asset was, it was a PPE. So the PPE is accounting standard 16. So PPE value 500 and is increased to 700,000. So it will go to revaluation surplus 200,000. And since this is valued at fair value, this won't be having any further depreciation. We have done 2 or 3 similar type of question in our class. During our IAS 40 class that we might have done in April or early May, June, July, at least 2 months or 2.5 months before. And during the revision class, again, we'll be doing one question. Revision class, I'll be explaining one concept and we'll be doing one question from each and every concept. Next. The next thing, it can be the opposite, like in this question. Initially, it was an investment property. Now there is a change in use. That means there was a building. You were holding this building for the purpose of earning rent. Now you decided, you remove the tenant, you ask the tenant to vacate. Now you're going to occupy that property. You're going to use that property for your business purpose. The moment you're going to use that property for your business purpose or that building for your business purpose, it becomes your owner occupied property. It becomes an owner occupied property. Now, let's take the same example. The investment property had a carrying amount of 500,000. So what's the journal entry you'll have to pass? There's a new asset coming. Actually, there is no new asset. It just changes the head. But still, if there's a change in the head, it's a change in accounting standard. So debit PPE and credit investment property. So as usual, when there's a change in use, the new asset, what's the new asset? PPE should be shown at fair value. Same example, fair value, let's say at the date of change, fair value was 700,000. So what you have to do, you have to record this new asset at its fair value, 700,000, whatever be the asset. And at the same date, you have to remove the carrying amount. What is the carrying amount? 500,000. Now there's a difference of 200,000. Where should this difference go? You have to check what was the nature of this asset initially. It was an investment property. In investment property, any change in fair value will go to SOPL. So credit SOPL. So if it was an original, so very simple. And since this is a property, plant and equipment, from now onwards, there will be depreciation. So very simple. There are only 1, 2, 3, 4, 5 points. I'm just going to sum up that 5 points. Point number 1, if there's a change in use, the new asset should be recorded at fair value, whether it be investment property or whether it is property, plant and equipment. The new asset should be recorded at fair value. The old asset should be removed from, you have to remove the carrying amount of old asset. So definitely there will be a difference between fair value and carrying amount. Will it go to revaluation surplus? There is only two treatment. One, that difference will go to revaluation surplus. Treatment number 2, that difference will go to SOPL. Why will it go to revaluation surplus or SOPL? Should it go to revaluation surplus or SOPL depends upon the nature of that asset initially. If initially it was a property, plant and equipment, then the difference will go to revaluation surplus. If initially it was an investment property, then that difference go to SOPL. If the new asset is investment property, and if investment property you are showing it in fair value, there is no further depreciation. And if the new asset is a PP, definitely there is going to be depreciation. That's it. We have revised investment property, and those students who are not sitting for the revision class, you got the revision related accounting standard 40 free of cost. Okay. So if you want to take a screenshot, you can take a screenshot as well. I'm just going to wait for a few seconds, so that you can take a screenshot as well. Here. Okay, so moving to our question. Read the question. On 1st October X4, okay, read from here. On 31st December X4, okay. The second property became owner-occupied property. When was that? 31st December X4. Now, this is an investment property, okay? This is an investment property. This was an investment property. Now, there was a change in use, and 31st December X4, this became an owner-occupied property. I'm going to use the word PPE, property, plant and equipment. The second became an investment property. Sorry, the second property became an owner-occupied property, and so was transferred to land and building at fair value of 6 million. So which value will record? You will record 6 million. 6,000. So I'm just going to write the journal entry here, so you'll be able to analyze and write it properly. So 31st December X4. debit, debit, property, plant and equipment, 6 million, 6,000. Credit, investment property. Okay, crediting investment property. How much I have to credit? What will be the carrying amount? Now I'm going to show you this and tell me what will be the carrying amount of investment property. What will be the carrying amount of investment property? See, investment property at fair value is 20,000. Out of this, you have sold an investment property worth 15 million. So what will be the carrying amount of property 2? It will have a carrying amount of 5,000. How about 5,000? I'm just going to write here. Investment property, total carrying amount. This is for your purpose. Total carrying amount is 20,000. Investments, then certain students say, sir, it's fair value. No, investment property at fair value means they are following fair value method. They are following not cost method, they are following fair value method. Total carrying amount of investment property is 20,000. Property number one, carrying amount. What is the carrying amount of, property number one, carrying amount. It's already given. Carrying amount of property number one was 15 million. So what about 17,000? 17,000 is sales proceeds. First property had a carrying amount of 15 million. Therefore, what will be the carrying amount of property 2? It will be this 20,000 minus 15,000, 5,000. 20,000 minus 15,000. So the carrying amount of investment property is 5,000. So there is a difference of 1,000. Now tell me, where should you show this difference? Revaluation surplus or SOPL? Okay, very good. Okay, SOPL. You have to show it in SOPL. It's not revaluation. Why? Why? You have to check what was the initial nature. Initial nature was investment property. Investment property will go to SOPL. So most of the students were able to answer it properly. I have explained it in detail. Still, if you are getting confused or making mistake, I will really ask you to attend the revision class. Really ask. So credit SOPL 1,000. So now this is my question. Credit SOPL 1,000. What will you show there? Is it add to retained earnings or less retained earnings? Is it add to retained earnings or less retained earnings? You have to add to retained earnings because it is credit SOPL. It's a profit. So add to retained earnings. Add to retained earnings. Control B, just 1,000. Okay, now, so investment property is now completely over. What else we have to do? What else is there? Then now they say its remaining useful life on 31st December X4 was considered to be 20 years. Okay, now they're saying that it's remaining useful life. So depreciation of that particular property, of this particular property. You can also write like that as an example. This particular property. So what is the depreciation of this particular property? Its value is now, its value is now 6 million. or 6,000 divided by 20. Now, that is for from 31st December X4 onwards. Your year end is on September. So into 9 by 12. Right. Into 9 by 12. So this is equal to 6,000 divided by 20 into 9 by 12. 225. Less retained earnings. We'll have a further discussion on this later. Less retained earnings. Okay. Working note number 4, I think. Working note number 4. Now read it. The price of property has increased significantly in recent years. The next paragraph. So the directors desire to revalue land and building. The directors accepted a report of an independent surveyor who on 1st October valued the land 8 million and building 39 million on that date. The revaluation specifically exclude transferred investment property described above. Okay, so working note, revaluation. So revaluation, they have given when was it was revalued on 1st October 20x4. Fair value of land, then building. Fair value of land is 8 million, so 8,000, and building 39 million, 39,000. Now the next one. The risk revaluation specifically excludes transferred property. So now we have to compare to find out revaluation surplus. We have to compare with carrying amount as on 1st October X4. So let's go here. Land. Anyway, land will not have a depreciation. So land, what was the amount in land? 5 million. So 5,000. Building. Building carrying amount. See, building cost is 30 million. How I got cost of building 30 million? The total is 35,000 land and building. Out of that, 5 million pertains to land. So 30,000 will be the cost of land. Now, 1st October, building is having an accumulated depreciation of 20,000. So minus 20,000. So this equal to 35,000 minus 5,000 minus 20,000 minus 20,000. This much of depreciation. Wait. Yes. Okay, moving forward. So how much is the total gain on revaluation? Building, it is 29 and the other one it is 3,000. So the total gain will be 32,000. So how much is revaluation surplus on 1st October X4? So revaluation surplus equal to land fair value 8,000 minus carrying amount 5,000 and building 39,000 minus 10,000. So total revaluation surplus will be 32,000. This you will write here, show in SOFP. Now, have this told you anything about deferred tax? Income tax rate applicable. Okay, what is the doubt? Now, what is the next thing? You have written till here. The remaining life of building at 1st October X4 was 15 years. So building will definitely have a depreciation. So working note number 5, depreciation Working note number 5, depreciation of building. Depreciation of building. You can just write in one sentence itself, depreciation of building. It had a remaining life. So building at what value will show? Revalued value. What is a revalued value? Building, it is 39 million. So 39,000 minus new residual value. If new value is not there, take the old value. It's not, nothing is there. So minus 0 divided by remaining useful life divided by 15. Now you have to check whether it is full year. When did you revalue? In October X4. When is your year end? September X5. So you have revalued in the beginning. So it is there. 39,000 divided by 15 for an entire year. This is equal to 39,000 divided by 15. Your depreciation is 2,600. Clear? So depreciation is 2,600. What you have to do? Depreciation 2,600. Don't write SOPL. So this is my next question. Is it add retained earnings or less retained earnings? Yes, very good. It is less retained earnings. Less retained earnings. So right here itself. Less retained earnings. Done. Okay. Now continue. However, revaluation will give rise to a deferred tax liability. Income tax rate applicable to Candy is 20%. So I'm just going to write small working note. Working note number 6. What is that? Revaluation to be shown. Revaluation surplus to be shown in SOFP. Revaluation surplus. The same adjustment is being repeated. What's the amount you have to show? I'm just showing here. Revaluation surplus less. I'm showing deferred tax separately itself. Deferred tax. Then you will get revaluation surplus to be shown in SOFP. So revaluation surplus. How much is revaluation surplus? F46 plus E46. Revaluation surplus equal to E46 plus F46. That is 3,000 revaluation surplus in land plus 29,000 in building. So deferred tax will be 32,000 multiplied by 20%. So this is equal to minus 32,000 multiplied by 20%, 6,400. So revaluation surplus will be sum of those two items, that is 25,600 show in SOFP. There will be also application on deferred tax show in SOFP. Okay, done. So we have written revaluation surplus as well. Now what's the next working note? Plant and equipment is depreciated at 12.5%. Read that particular item as well. Plant and equipment is depreciated at 12.5% per using reducing balance method. No depreciation has been charged only on any non-current asset. So working note number 7. You can have multiple working notes. Working note number 7. Depreciation on plant. They follow reducing balance method. So depreciation on plant, reducing balance method. Cost, I'm just writing here itself in one line itself. Cost 58,500 minus accumulated depreciation 34,500. Now you have got carrying amount multiplied by 12.5%. So depreciation on plant is equal to 58,500 minus 34,500 multiplied by 12.5 percentage. I have to show it in brackets. Sorry. Less retained earnings. Clear? 3,000. Now what's the next one? The last working. A provision of 2.4 million is required for income tax on profit for the year to 30 September X5. Balance on current tax in trial balance is under over provision. In addition to the temporary difference relating to information in note 2, same point, same repetition, Candy Company has further taxable temporary difference. See, everything is repeated. That is why I told you practice as many as many past question papers as possible. It will really increase your chance of passing. And if you're really good, it will really increase your chance of getting a rank as well, getting a global prize as well. So working note number 8. Tax charge in Sopl. So current year, current tax provision. How much is it? It's given 2.4 million, 2,400. Add under provision of previous year. Regarding current tax, I'm just skipping it. Less over provision of previous year. Now check. Current tax, it is in credit side. That means it is an over provision. So this is 0. This is minus 1,100. Then current year deferred tax provision. How will you find current year deferred tax provision? Temporary differences or taxable difference excluding revaluation surplus multiplied by tax rate. So the question very clearly stated that in addition to temporary difference related to information number 2, that is revaluation surplus, Candy has further difference of 10,000. So 10,000 multiplied by 20%. So this is equal to 10,000 multiplied by 20%. Then add under provision of previous year, that is related to deferred tax, less over provision of previous year related to deferred tax. Is there anything given? Yes, deferred tax 2,500 credit. It means over provision. Credit means over provision and debit means under provision. Sum. So 800 is tax charge in Sopl. Done. Okay. So now remember tax charge in Sopl less retained earnings. Then this one show as deferred tax in non-current liability. This amount as well as revaluation surplus deferred tax. Add both those things. And this one is show as tax payable under current liability in SOFP. Okay, that's it. Now we have to prepare an adjustment Sopl. Just give me 1 minute. What I'm going to show you is we have already done this question. FR, PPTs, Accounting Standard 12, Income Tax. The same question we have done in the classroom, in our IAS 12 classroom. See, specimen exam. You already done that. This question was also from specimen exam. You're practicing specimen exam. It has been already done. Okay, now let's quickly prepare answer A. Answer A. Schedule of adjustments required. So you can simply say adjusted retained earnings. Adjusted retained earnings. Dollar thousands. So adjusted retained earnings start from given in trial balance or as per trial balance. As per trial balance equal to their given 15,500. Now do all the adjustment required. 15,500 one by one equal to 15,500. The first one was loan note interest. So it will be less loan note effective interest. Then from second one, there was gain on disposal of investment property. You have to remember the question. Then second one, there was gain on investment property, fair value, investment property. So I'm just going to write fair value gain on investment property as well. That change, SOPL. Then there was a few depreciation. One, depreciation on property change of use. Just give that, then examiner will know that. No need to write in proper English. Then depreciation of land and buildings. The building, there is no depreciation of that other than this property building. Then depreciation of plant. Then tax charge. If there is anything else, we will write it. Then tax charge. Then loan note issue cost. Loan note issue cost. It was the first one. So this is those adjustment. So let's go and fill up this. So loan note issue cost, add 1,000. So directly we can go there and add 1,000. Now, interest, effective interest rate F6. So equal to loan note effective interest rate equal to minus F6. Gain on disposal of investment property, add 1,000 to 29, add to retained earnings, profit on disposal. That is F17. It's better you write everything in scrap paper equal to F17. Then, sorry, it's not F17. I think it will be F18. Yes, F18. Gain, so add F18. Then add to retained earnings, investment property, that gain. That gain was F25. that 1000 equal to F25. After F25, less retained earnings. It is F37, then depreciation F48, 37 and 48. 37, 48, 59. 37, 48. I forgot what I told. I think it is 59. 3000. Depreciation of plant. Yes. Tax charge in SOPL. That is F78 equal to minus F78 equal to sum 10,265. Okay, that's a very nice question being asked by a student. I'll read that question. So this is adjusted retained earnings. You have to read that question very carefully. Okay, now even if you have messed up, don't worry, you will get very good marks if your calculation is right. All these calculations are right. Now the student has asked me this question. So the draft retained earnings is as per 30 September X5. So shouldn't we do everything in reverse? No. Why? Read the question. After preparing a draft statement of P&L and year ended 30 September X5 and adding current year's draft profit, before any adjustment required, note 1 to 3. So the retained earnings you have got 15,500 is before any adjustment you have done. That means no depreciation has been calculated, gain has not been calculated. All of that 15,500 is before this adjustment. So do this adjustment and add to profit or less to profit. So this is before any adjustment. Clear? And I think you might have gone through any past question paper. There was one past question paper saying it was after all those adjustment. If it is after all those adjustment, we'll have to recalculate and reverse your working. Clear? Now, within few minutes, it's now 5:08. We will wind up in 7 minutes. We'll quickly prepare SOFP as well. So answer B. SOFP as at 30 September 20x5. So what's the first one? We'll start with asset. Investment property. Read. First asset is investment property. My first question. What will be the value you'll show under investment property? Please tell the answer. Investment property. If you remember the question very properly, we'll be able to answer. Known assets. It's assets. Please, what's the value of investment property? How much? Please quickly type the answer. Yes. 0. Yes, very, very good. It's 0. Why it is 0? You have got two investment property. Property number 1 you sold. It's not there. What about property number 2? That property number 2 having 5 million or 5,000 is no longer investment property. It has been transferred. It is now property, plant and equipment. Like certain MPs and MLAs from a particular party, they say goodbye and they join another party without any conscience. That the first, for a long time, they will be accusing the other party, accusing them. Then one fine night, they will offer something. They will say goodbye, offer them some money or offer them a new seat or a berth in a cabinet minister. They say goodbye and join the other party. Like this was your investment property for so long time. Now they have shifted that alliance. They have now become property, plant and equipment. So there is no investment property. So now let's go to the land and building. Okay, now listen very carefully. land. I'm just splitting this, okay? Land, so that you don't make a mistake. Land and building. Separately, I'm showing. Land, it was revalued. Land was revalued and land is now 8,000. This was revalued at the beginning. Since land doesn't have any depreciation, we don't have to bother. Building, okay, building, it was revalued to 39,000. But there's a depreciation for this building as well. What's the depreciation for that building? 2,600. It doesn't end there. It doesn't end there. Now, that's an existing building. Now, what happened? Another investment property came into the picture. What was the value of that investment property? The value of that investment property, is it 5 million or 6 million? The investment property that you have shown as a PPE, is it 5 million or 6 million? Do you have to add 5 million or 6 million? Please tell the answer. You have to add 6 million, 6,000, because you have passed the journal entry, debit PPE, 6 million. So that's 6 million, 6,000. The investment property that has become this one. Now, since this investment property has become, it has got a depreciation as well. We have also shown the depreciation separately. If I'm right, it was 225. So minus 225. So 39,000 plus 2,600. Sorry, it's minus 39,000 minus 2,600 plus 6,000 minus 225. So I'm just going to show here all those things. This is equal to 39,000 minus which column I have to do, right? Minus, what is that 2,600? Minus 2,600 here. F48. So minus F48. Then add 6,000. What is that 6,000? F23. Minus depreciation of this particular item. F37. 42, 170. So your total land and building will be 50,175. Now you have one more asset. Land and building done, investment property, plant and equipment. Plant and equipment. Plant and equipment. What's the value you have to show in plant and equipment? Plant and equipment, as you're aware, plant and equipment, cost of plant and equipment is 58,500 minus minus accumulated depreciation of 34,500 minus current year depreciation. How much was current year depreciation? 3,000 minus 3,000. So depreciation F59. So all this information are there. So you can simply write it. 58,500, it is from question. Minus 34,500, also from question. Minus F, I forgot. I think it was 59. F59. Yes, F59. 21,000. So your total plan, this will be how much? Sum. Okay, I'm not summing up. No need. So plant and equipment is over. Now what else? There is only current asset. So current assets, only one current asset, 68,700. That's it. So why are they giving you 9 marks for the small calculation? This 9 marks is not for SOPL or SOFP. Your working will carry the most marks. So that is why I am telling you every time, write in the bracket where will you show. So even in your examination, if you forget to show it, you will get enough mark. So total asset is 875. So total assets. Next one, equity and liability. You wind up in another 5 minutes. Equities and liabilities. So first one is equity shares. Nothing happened to equity shares, no share exchange, nothing. So you can take it as such, 20,000. Next, retained earnings. You have calculated retained earnings. The adjusted retained earnings. In your examination, let it be there. Any spelling mistake, no need to correct. Let it be there. So retained earnings, adjusted retained earnings, F100 equal to F100 as per my Excel sheet. What is there? After that, don't forget, there is a revaluation surplus. Revaluation surplus equal to, as per my calculation, revaluation surplus to be shown in SOFP 25,600 F57. After revaluation surplus, no further equity. So non-current liabilities. Non-current liabilities, there will be two non-current liabilities. One, there's a convertible loan note. Sorry, there's a loan note. 6%, not convertible. There's a normal loan note, 6% loan note. Then there is deferred tax as well. 6% loan note equal to here F12. Sorry, F12 equal to F12. Deferred tax, remember, with respect to revaluation surplus, there's a deferred tax. How much is that? In this question, I've shown you separately. Revaluation surplus deferred tax separately 6,400 F55. Then one more. In current year deferred tax provision, again 2,000. So 6,400 plus 2,000, 8,400. When you write in current liabilities, non-current liability, you have to take both 6,400 plus 2,000. No need to show this in bracket in your examination. This is what you have to do in examination. Equal to, you write that particular item. You give reference to that particular cell. That is F55. Since it is minus, I'm writing F55 plus 2,000. It is in F70. This is what examiner has to give. How you got this 8,500? So when he check, you'll see this F55 and F70. So he or she will know that. Deferred tax is over. Now next one, current liabilities. Just 2 more minutes. Current liabilities. What are the current liabilities? One, directly given. So we have taken equity, retained earnings, loan note, investment property, land and building, plant and equipment, accumulated depreciation, current assets, deferred tax, interest paid, current tax, and suspense account. There will be no suspense account. Current liability is 68,700. It's already there. As per trial balance, how much? Sorry, its current liability is 43,400, and the last one is tax payable. The last one is, sorry, tax payable. Tax payable equal to your column in tax charge, the first item, current year provision. Always current year provision will be tax payable, F64. So what about the suspense? That suspense account they have given disposal proceedings. So that means of investment property. We have removed investment property. So automatically it has been adjusted. 139,875, perfect. And 139,875. our SOP has been tallied, total equity and liability. So what you have to understand is that basically if you know accounting standards, single entity is simply adding and subtracting it accordingly. So total equities and liabilities. So that's it. I'll be sharing these notes with you mostly today itself if I get time. Today's Sunday. Okay, so that's all everyone. So see you tomorrow, and tomorrow will be our last day. So what are we going to do tomorrow? Tomorrow we are going to do a few things. One, we are also going to do one more single entity question, just one more question. And after that, what I'll be doing is that I'll be giving a timetable in the Excel sheet. I'll be forming a timetable in the Excel sheet. If you're attending a revision class, what you have to do. If you're not attending a revision class, what you have to do. We will do a timetable and allocate a few time and create a timetable. I will create a timetable for you. Then what will you do one more thing? I will have a discussion about cash flow statement for 15 to 20 minutes. We won't be doing any problem. I will give you a whole brief explanation about cash flow statement. So that if at all I upload one or two questions, you'll be able to understand that. There is one more question, prepare Candy's extract of statement of cash flow. I'm not going to do that. That part we'll do tomorrow. I'll explain cash flow statement tomorrow. So what are we going to do? We are going to do one single entity question tomorrow. And I'll be explaining cash flow statement tomorrow. And we'll be setting a timetable tomorrow. And one more thing. A thing that has been stated in the examiner's report, in a particular examiner's report, how you have to approach multiple choice question and objective type question. And what are the common mistakes committed by the students in objective type questions, and taking all those things, examiner has given in one of the examiner's report, examiner has given a few suggestions how you have to write or how you have to approach and analyze objective type questions as well as multiple choice questions in the class. That part also will be discussing. So as usual, tomorrow's time, the last day of our time, we are reaching our climax. We have started our class on April 20, May 20, June 20, July 20, August. It's almost nearly 4 months and almost 100 plus hours. Our promise was around 40 to 50, or I don't remember, 50 to 60 hours. We have far exceeded that, 100 hours. So now that is our last day. So tomorrow we'll see at tomorrow at the same time. Since it is Monday, it will be at 2:30 p.m. in the afternoon, Indian Standard Time. So see you tomorrow on our last day. Thank you everyone, and please stay safe.